As I discussed in a prior video, there are certain reforms that have been proposed which would affect the tax treatment of grantor trusts that are created after a certain date, as well as contributions to an existing grantor trust that happen after a certain date. There's a very low likelihood that these reforms will be enacted, but nonetheless, beyond the basic issues discussed in my first video, it's important to know how these reforms would affect Crummey rights under trusts. So, this presentation is all about what you should know when it comes to Crummey rights and how they may be affected by grantor trust reforms. Now, there are some unanswered questions and there's a huge conflict within the code that we're going to look at. So, for the time being, I think it's important to keep in mind that Crummey rights, if this grantor trust reform is indeed enacted, may not be a viable method for funding a trust, at least until we get more firm guidance. And that's speculative, but nonetheless, there are some important issues you should consider when planning for your clients. Now, before I get into the presentation, a little bit about me. I do what I do because I enjoy speaking and teaching. So if you enjoy this video or like any of my other content, and you'd like to have me serve as a speaker at your upcoming event, you can reach me at griffin.bridgers@gmail.com. And if you'd like to subscribe to my newsletter, you can visit griffinbridgers.substack.com. Now on to the presentation. So I'm going to start out by giving some basic information about Crummey withdrawal rights in general, and then we'll dive into the more advanced issues that come into play when we look at how these could be affected by some of the proposed reforms. So, anybody who makes a gift, called a donor, has a gift tax annual exclusion of $15,000 per recipient or per donee. But there's a catch. That doesn't apply to every gift. That annual exclusion only applies to gifts of present interests, which is a loose term, and instead of defining it, we're going to look at it in the context of a transfer to an irrevocable trust. So a completed gift transfer to an irrevocable trust generally is treated as a future interest and wouldn't qualify for this $15,000 gift tax annual exclusion. There are some statutory exceptions to this which are kind of outside the scope of our discussion today, but may create, in a subsequent episode I may put out, maybe an out or a consideration to get around some of these issues. But for the time being, what we're going to focus on is the fact that outside of the letter of the code itself, there's been some prior case law and prior IRS rulings, which I won't get into in depth, but they condone a backdoor method of creating present interests for transfers to trusts. And that's through what's colloquially known as a Crummey right or a Crummey power or a Crummey withdrawal right. And that's really named after the family, the Crummey family, who went to tax court against the IRS to really fight the IRS on the gift tax treatment of this right. So what is a Crummey right? Well, generally, it's a temporary right that's granted to income beneficiaries of a trust, some or all of them, to withdraw a portion of the contributions to the principal of the trust that may happen in any given year. And I said this is a temporary right, and the typical top of the bell curve is that it would last for a limited period of time, often 30 days or maybe as long as 60 days, or sometimes if it's less than 30 days, you could say it lasts until maybe the end of the year, like December 31. But there has to be at least a meaningful period of time during which an income beneficiary can withdraw their share of a contribution. And the amount of the withdrawal is typically limited to each income beneficiary's share of the contribution to the trust, may be an equal portion, or if less, the amount of the gift tax annual exclusion, which is $15,000. And I'll briefly explain in a minute that usually the withdrawal rights would be equal among all income beneficiaries, except in the case of a spouse, because a spousal withdrawal right is typically going to be limited to $5,000 for generation skipping transfer tax purposes. Now, if this withdrawal right is not exercised in the time allotted, then it goes away. This is what's known as a lapse. And the lapse is going to create all sorts of issues. It's going to send us down a rabbit hole of tax law treatment for that withdrawal right that's really going to cause some problems, especially if grantor trust reform is indeed enacted. So, for estate and gift tax purposes, the Crummey right is a general power of appointment. The significance of that is that any general power of appointment is treated as if it creates ownership of the property that's subject to that general power of appointment by the holder of the power. So, for example, if a beneficiary dies while holding a withdrawal right, the IRS treats the amount they could have withdrawn as if it's owned by them at the time of death. This causes inclusion of a portion of the trust subject to that withdrawal right in the beneficiary's gross estate for estate tax purposes. So that's pretty easy, and that's something that applies regardless. But another issue arises where there is a lapse of a withdrawal right. If that happens during the beneficiary's life, as would often be the case, because there's this 30-day window to really withdraw funds, what that's treated as is an indirect gift from the trust beneficiary that held the withdrawal right to the other trust beneficiaries. But there is an exclusion, there's an out, because there's kind of a floor under which there's no taxable gift here. So the taxable gift only applies to the extent that the lapsed amount of the withdrawal right exceeds the greater of $5,000 or 5% of the amount that was subject to the withdrawal right. Now, since most Crummey rights are $15,000 or less, we're usually never going to worry about that 5% amount. Typically, your non-taxable lapse will always be $5,000 or below. So long story short, as long as the amount that lapses is $5,000 or less per year, there's never any gift tax issue for a beneficiary that holds a Crummey withdrawal right. And we'll look at the math on that in a minute. But long story short, what this means is that as a 30,000 foot view, if a beneficiary could withdraw, let's say $15,000, and only $5,000 lapses per year, it means that 30 days goes away and extends to perpetuity for the remaining portion of that $15,000. In other words, $10,000 is left that could be withdrawn. Now, I mentioned the spouse earlier, and typically the spouse will be limited to a withdrawal of $5,000 because any general power of appointment that's given to the spouse in excess of that amount will create what's known as an estate tax inclusion period, or ETIP, for generation skipping transfer tax purposes. And that could bar allocation of GST exemption to the trust until the spouse's power lapses. So that's why we typically limit the spouse's power to that $5,000 amount. And that's for the withdrawal right, not the lapse portion. But that aside, the context of that is a little bit outside of the context of today's discussion. But we're going to look at a quick example here. We're going to assume we have siblings Alan, Betty, and Charlie, and they each have a withdrawal right of $15,000, which lapsed. So Alan's lapsed withdrawal right will be treated as a gift back to the trust beneficiaries, and it's allocated really $5,000 to Alan, $5,000 to Betty, and $5,000 to Charlie, assuming they're the only withdrawal beneficiaries and assuming there are no other beneficiaries of the trust involved. So in this simple scenario, Alan's lapse would really be a combined gift of $10,000 to the other two siblings. Why only 10? Because Alan's $5,000 gift to himself isn't going to be subject to gift tax. That $5,000 really stays in trust for his benefit. But note that that gift, the combined gift, is only taxable to the extent it exceeds $5,000. So in essence, Alan has made a $2,500 taxable gift to Betty and a $2,500 taxable gift to Charlie in this scenario. So there's a few ways we get around the lapse issue. One is You could limit the lapsed amount to the greater of $5,000 or 5% per year. That's called a hanging power. You could also create separate subtrusts for which the beneficiary is the sole current beneficiary for life. So that lapsed amount, or that amount over the lapse, the $10,000 in Alan's case, never goes to Betty or Charlie. So in this case, the remaining $10,000 balance using hanging powers or subtrusts as an approach would continue to be an open withdrawal right until it lapses in a later year. And you could see how this could accumulate with respect to Alan if there is an annual $15,000 contribution. Because Alan would have a $10,000 balance that rolls over from year one. He'd have another $10,000 balance that rolls over from year two, so that now he has a cumulative withdrawal right of $20,000, and so on and so forth for perpetuity. So essentially 2/3 of the trust would constantly be owned by Alan with respect to contributions that are subject to Crummey rights. Now, eventually, if this cumulative withdrawal right exceeded $100,000, then you could bump into using the greater amount of 5% to determine the lapsed amount. Otherwise, there's only $5,000 lapsing every year. Now, that seems complicated, but it's easier than when we have to tackle the income tax issue, because what we're going to see is that even though a lapse of Crummey powers can cause the gift and estate tax issue to go away, it never really truly goes away from an income tax perspective. Because if there's a trust with respect to, or if there's a trust that's a grantor trust with respect to the actual grantor, there's no income tax issue with Crummey rights unless and until the grantor trust status terminates. At that point, the beneficiaries could become grantors of that trust with respect to the portion of the trust that they can withdraw at any given moment. So you can see how this can compound over the several years that Alan accumulates withdrawal rights. But the problem is the 5x5 lapse may not apply for income tax purposes. So Alan's income tax ownership may extend to the full $15,000 per year and not just the unlapsed $10,000 portion. The other problem is that the beneficiary's rights here can never truly be released in full as long as they're a beneficiary or a trustee of the trust. Because as long as the beneficiary remains that status and has the right to receive income or control distribution of income, it's still going to be a grantor trust with respect to that beneficiary. So all you can do to avoid that issue is maybe let the withdrawal rights lapse out, but even then, that may not be enough. Now, how does this tie into the grantor trust proposals? Well, as we've previously discussed, one of the current reform proposals will change the tax treatment of grantor trusts for non-grandfathered transfers that happen after the effective date of the law. Now, currently, the grandfathered transfers would only be disregarded for income tax, but would be respected for estate and gift tax, essentially. But non-grandfathered transfers could be disregarded for all tax purposes, income, gift, and estate, and even GST tax, which applies concurrently with the gift and estate taxes. So, how does this apply? Well, with respect to the actual grantor of the trust, there's been talk about converting grantor trusts to non-grantor trusts with respect to the actual grantor. But even after doing so, the trust could still be a partial grantor trust with respect to any cumulative withdrawal rights that have accumulated with respect to any particular beneficiary. So how does this play out? Well, first it's important to note that Code Section 2901 is not going to apply to any portion of a trust which is already included in the gross estate of the deemed owner. Now, what we haven't mentioned is that all those cumulative withdrawal rights that exist under that trust would cause estate inclusion and would essentially disregard that portion of the trust for estate tax purposes anyway, and will disregard it for gift tax purposes to the extent amounts that lapse in any given year exceed $5,000 or 5% of the cumulative withdrawal right. Now, it's also important to note that this section shouldn't apply to grandfathered transfers, so the problem we're going to look at is only going to apply to transfers that are subject to a Crummey right to a non-grantor trust after the effective date of Code Section 2901 and 1062, as we're going to look at. So, with that being said, it'll also only be an issue if a Crummey beneficiary makes a gift by transfer or lapse after Code Section 1062 is enacted, or if a Crummey beneficiary sells or exchanges assets with the non-grandfathered portion of the trust after Code Section 1062 is enacted, if it is indeed enacted. Now, there's a big mismatch in the code, and this has long been an issue before the grantor trust reform was proposed, and that's that the only section of the code that deals with this lapse threshold of $5,000 or 5% is found in Code Section 2514E and 2041B2, which deal with gift and estate taxes. They don't deal with income taxes. Now there's a Code Section 678A2 which disregards a release of the right to withdraw principal or income of a trust if a beneficiary continues to be a deemed owner, maybe as a beneficiary or a trustee, under Code Sections 671 to 677. Now, semantics-wise, a release is an affirmative act, but a lapse is the result of inaction. Can the two be equated? It seems intuitive that under the letter of Code Section 678A2, it doesn't speak to a lapse, it only speaks to a release of a power to withdraw principal or income. In other words, it only speaks to a release of a Crummey right, which would assume an affirmative act. But Code Section 2514E treats a lapse as an affirmative release of the power. Now, even though that's found in a separate code section, there have been some prior rulings which have equated these two concepts for grantor trusts. And what that means is that the cumulative withdrawal rights that are under that $5,000 lapse for gift and estate tax purposes never actually lapse for grantor trust purposes. So what that means is that, as I mentioned, Allen's cumulative withdrawal right when it comes to the grantor trust effect would not just be $10,000 per year. It would be $15,000 per year, growing to perpetuity. So that's the issue to keep in mind for transfers to non-grantor trusts that are not grandfathered. In other words, they happen after the effective date of these laws if they are indeed enacted. So there's a big mistake, I think, in the proposed Code Section 2901 because it sets the standard for gift or estate tax treatment as being concurrent with and reconciled with Code Section 678A2 and the gift and estate tax regulations. In other words, it could disregard this $5,000 or 5% lapse right that could happen to avoid gift and estate tax issues. So what that means is that any lapse of Crummey rights could be disregarded for gift and estate tax purposes under Code Section 2901, and that could potentially create a conflict or maybe even override the respected lapse under Code Sections 2514 and 2041. Now, reconciling this is a whole other rabbit hole that we can't really go down. But what does this mean lapse-wise? Well, once again, going back to our example that we looked at before, it would mean that Allen's withdrawal of $15,000 per year stays at that amount and never really truly goes away under Code Section 2901 for any Crummey rights that are created for a non-grantor trust after the date of enactment of that code section. Now, why do I say a non-grantor trust? Well, if it's treated as a grantor trust with respect to the actual grantor and not the beneficiary, then that tax treatment overrides the tax treatment of the Crummey right. You only have this issue kick in with respect to a beneficiary if the actual grantor is not the deemed owner of any trust assets. But what this means under some prior IRS rulings is that Alan would every single year become the deemed owner of an increasing portion of the trust, which should be a non-grantor trust. So that would create an inadvertent grantor trust with respect to Alan and any other Crummey right holder, which will continue to grow and grow and grow and never really go away as long as they are beneficiaries or trustees. But since Code Section 2901 creates gift and estate tax consequences, and since the lapsed portion of the $5,000 or 5% is not subject to gift or estate tax, the question is whether Code Section 2901 would override and disregard that lapsed $5,000 or 5% portion. And that's something that hopefully is reconciled if this proposal does indeed gain steam and does get enacted as law. But for the time being, this creates a wrinkle that makes it difficult to plan around a lapsed Crummey right in the future for any sort of grantor or non-grantor trust. So hopefully that didn't confuse you more than educate you. The problem is we just don't have firm answers on that issue. But I hope you enjoyed this presentation. I hope it added value for you. If you have any questions on this material or even topic suggestions for future presentations, you can email those to me at griffin.bridgers@gmail.com. As a reminder, I cannot give tax or legal advice in response to your questions. I can only answer questions specific to this material or any other material I've spoken on. And if you've enjoyed this, I'd encourage you to check out my YouTube channel. Just type in Griffin Bridgers to YouTube, or as I mentioned, sign up for my newsletter at griffinbridgers.substack.com. But thank you for joining me for this presentation, and I look forward to seeing you in my future videos.